Hey everybody, we are back. It is that 3 o'clock time frame on Thursday. Welcome to Market Mavericks. I'm joined by Mike McGlone and Scott Melker. How are you guys doing today?
Wonderful.
Oh, good.
Awesome.
Hello.
Very cool. Yeah, we're getting we got some great stuff to talk about with Bitcoin, obviously. What a monster move. I guess let's start there. Scott, give us your read, man.
I mean, it's ETF hype, of course, right? We all know that. Everybody believing first that there was fake news that had already been approved last week, but now seeing impressive follow through with people buying into the idea that it will. Funny, we got fake news by Cointelegraph a week ago on Monday while we were live, Mike. And then this week we got basically fake news by a BlackRock being listed IBTC on the DTCC website. And then it wasn't listed, and then the website was down, and then people didn't know if it was listed. Comes to find out that it had been listed there since August, and that was basically a nothing burger, but furthered the idea that BlackRock will already be seeding a fund, starting to buy in advance of an approval. And I think that that's what's happening here. Either way, regardless of the narrative, it's incredible to see this divergent strength when everything else seems to be dropping. And look at these weekly candles here, just going into overbought RSI. On lower time frames, that's when a lot of people start to get concerned. But on higher time frames, that's when the party usually starts. You get into these overbought conditions. You can look back in 2020. Bitcoin hit overbought around 12,000, went to 69,000 while staying overbought, if you look to that, right? So pulled a casual 5-ish or more X from that point. So that doesn't really concern me. I think we're going to consolidate here under 35,000. If we get another push, then I think we'll get some retracement. So I'm not rushing to buy at $35,000 or $34,000 Bitcoin, but I do think that the trend has switched. We made a higher high at 25,000. We broke the yearly high at 31,800. You can't fade that mentally. I think that's when you start to see sentiment change.
Do you think so? One of my questions would be: do you think that the Bitcoin spot ETF is being factored in now, meaning that when that news does hit, it'll have a minimal impact on price, or do you still think there's another whole leg up when that gets approved?
At this point, I think there's another whole leg up, and that's actually contrary to what I believed before I saw what happened the last 2 weeks with all of this sort of fake news, But my opinion is either way, obviously, Bitcoin has gone into a buy the dip sort of market. I wouldn't be looking to short an asset that's just breaking through key levels. So you're looking for dips to buy, not rips to short. That's the opposite of stocks. I'm looking for strength to sell into in the stock market. Here, I'm looking for strength to, for weakness to buy into on Bitcoin. So it's just it's very strange to be talking about them in such opposite terms, but that really is my view. I think that it's, you hear buy the rumor, sell the news. I think we buy the rumor and then buy the dip that comes after the news if it comes.
Nice. Mike, what is your take on it? What do you think? What do you think's going on here?
Well, I think, Scott, to me, what you just said, Scott, is very profound. Is it really, I think, is an example of how market sentiment has shifted. We've been looking for a sign of a divergent strength. We got it. And this is what I show you I like to show you a bit of a long-term chart. Is Bitcoin's obviously breaking above that 30,000 level. Now it's good support. I think you're going to see responsive buyers below there, particularly as the stock market pressures all assets lower, which I think is going to continue in a normal recession. What I show you in this chart is something that Dave Weisberger has been talking about forever, is this rapidly rising hash rate. So the strength of the market. And then just one thing that's kind of unique is maybe what's happening in Bitcoin is what you see here. This is a downward measure of total holdings of gold ETFs in ounces. So that metric, I think someday is going to show up in Bitcoin. There'll be a total holding of Bitcoin in ETFs. But this is quite significant for Bitcoin. But I want to just tilt over for a few other things if I can, and just show a few charts real quick, and then we'll go back on. This is a key thing about today's number. GDP, real GDP around 5% was quite significant, but our economist Anna Wong said they're short-term things. It's inventory, it's fiscal stimulus. It's very unlikely to continue and manage. And I think her point is by the end of this year, that's going to be tilt towards recession. Now, that's only a few months left. The number one thing I think is going to matter, as Scott pointed out, is that simple little 200-day moving average in the S&P 500. We finally broke below it. Remember that little kiss? That was the kiss of death. We all knew it. You kind of saw it. It was a classic trader's inverse. And I see you smiling because it's sometimes as a trader, you think, okay, well, that's a good little negative thing. When everybody on the screen says you're supposed to buy it, all right, hit the bid. So to me, this is a key thing. But what's notable about this is our a model for recession in 6 months is at 100%. Stocks are supposed to go down. Well, maybe we'll get lucky. Just a few quick charts, and I'll go back. Here's the same thing: 200-day moving out day on the Nasdaq. Now, you usually don't watch these kind of things, but to me, now it's such a psychological state because we've had this tilt towards recession, this tilt away towards recession. And now I think it's going to be self-fulfilling. Once we start destroying wealth, which has been kind of the goal of the Fed, it's going to continue lower. So just want to show you this other chart. I showed you that one already. U.S. government 10-year notes probably peaked around 5%. I've been saying that. I thought they peaked at 4%. Wrong. But this fact here, to me, is part of the reason all risk assets are going down, because that's a pretty significant tightening. Just look at the housing market and what's happening with gold. I think gold's going to be as simple as possible. This is just a chart of gold and the S&P 500 on the same scale, going back to when we came off the gold standard. And every time gold is this cheap, the S&P 500, we get a recession, which is what we show here in leading indicators. Gold just and S&P 500 do something very simple. They just converge. It's not complicated. So I'll show you one final chart. Digging in stuff that I want to show, stuff that you guys might not look at a lot, and that's copper. What I show you is copper in this orange line, and overlaid on the same scale as the S&P 500, divided by 1,000. And one key pressure factor for all of it, and this is just Fed funds futures in 1 year. It's one thing I look at a lot, is what is that still telling us about liquidity? There's going to be no hope from the Fed. So, it's shocking. It's impressive to me that Bitcoin is doing that divergent strength. I hope it continues. But that is pretty impressive for an asset that has basically 3 times the volatility of gold in the S&P 500.
Nice. Very nice. I'll just jump to my screen real quick. I just want to show a couple things on Bitcoin here and just give some insight on more of a shorter term trading basis. And so, again, you had the great move up. I caught most of it. I sold half at 31,000. We talked about this on Crypto Town Hall. My next sell was at 34,000, where I unloaded the remaining position of that. And the only reason, by the way, I wasn't long on Bitcoin until we got through this downsloping trend line right here. Once we broke that downsloping trend line, that was a trend change. It kind of broke above there. And then I got long kind of in this 27,000 range, wrote it up there. Now, I did pull the trigger on a short, but again, remember, folks, I'm a shorter term trader. So I'm short at 35,175. The target here is just a classic retrace to the breakout level. So as a technician, you really don't want to ever be just a perma bull or perma bear, right? And so what you want to notice here is that you've now broken this high going back here, and I could even drag that trend line back further and further, and it gets into some major levels going back to the bull market lows of 2021. So this was a major break point. And so essentially, once you've broken it, we now have to respect that as resistance broken, which now means it's support. And therefore, my target on a short, if it gets in that range of like 31.5, 32, I'll step aside. I'm not sure if I'll go long, but needless to say, you would remain bullish unless you trade back below that level. Now, that would be the kiss of death, in my opinion. If Bitcoin starts trading back below 30,000, for instance, that would be very problematic in the overall chart. Just asking you guys your opinions here. Do you think that we ever see 20,000 on Bitcoin again, or are we now is this kind of the next bull market where pullbacks will be more shallow?
Go ahead,
Scott.
Mike.
You
I don't think so. I don't think so. I think that listen, okay, let me rephrase that. Nothing's in absolutes. I would say that there's a 90 to 10 chance that we don't see it again at this point, or even 80-20 if I want to be a little more reasonable and not as ridiculously bullish. You just alluded to it now. We kept talking about if we lose 25, we're going to 20.
Right.
Once you're above the yearly high and that sort of 31,500 level, now you say, oh crap, if we lose 31, we're going to 25. Right. So now we've got a long way to go before 20. And it's going to take a hell of a lot of selling to get there. And I just don't see the sellers in the market right now. It's very clear that there is a bid on Bitcoin right now. Right. And it's a small asset. It mostly maybe travels in correlation at certain times, but it does have low liquidity, low volume. And when you get enough interest, it can clearly travel a different path than everything else. So I'm really looking at Bitcoin in a vacuum right now. Maybe I'll pay for that in the not so distant future. But for now, I look at this chart, I look at what's happening fundamentally, and I say, this thing wants to go up, right? Yep. And I'm not going to fight it.
So I'm always worried to say never. So I show you my screen. To me, my base case is the S&P 500 goes down to about 3,000. So that's pretty significant for some people, but for other people, when you overlay with copper, it's nothing. It's just going back to normal reversion. There's good reason for that. Here, what happens in recessions? Stocks go down. Sorry to give people the bad news, but and we're pretty high probability we're going to have that. So the key thing is if we can take wealth away from most risk assets, the S&P 500 go down, the number one beta measure in the world. And if Bitcoin just stays the same price, that's pretty significant. What's been happening lately is very impressive that it's going up and the stock market goes down. But we all know because the minute you launch that ETF, it might change a little. So I think with the way you've got it, Gareth and Scott, you both focus maybe more on the trading. In the long term, yes, this is showing what most of us expected to do over time. Decline in supply, increase in demand and demand adoption. Price must go up over time, but it's getting past this recession. And this, what I fully expect is just a bit of reversion and wealth creation. And so far so good. But again, it's to me, this chart to me shows the bigger picture. You're going to have a normal crash in the stock market. If Bitcoin can just stay buoyant in that environment, that's great. The key thing is we're not going to get that liquidity from the Fed. At least
I definitely think we're not getting the liquidity from the Fed. I agree that unless something severely breaks. And Gareth, if we go to 20, man, at this point, I don't like to do this on a show, but like I'm selling the kids, I'm selling the cars, I'm selling the house, and I'm getting it all into Bitcoin at that point. Sorry, kids, I love you.
A kidney too.
But I'll buy you back with my profits.
Yeah, man, for sure. So I would just flipping over now. We did get that GDP data today. So the GDP data came out. It obviously was stronger than expected, but we saw the markets we actually saw yields actually selling off on the GDP data. And I'm showing my S&P chart now. The S&P initially rallied up when the yields were coming down, and then the S&P bottom fell out. And interestingly enough, we came down and you can see the wick we're actually, or the tail, the wick here, the tail we're making, but we actually hit this really major technical level. Now, as a trader, and I want to preempt this by saying this, I still think overall in the macro, the markets still have a lot of downside like Mike does. I think Scott thinks that as well, but you can't deny the technical. I mean, look at this support level here on the S&P. And I do think that you might be setting up for at least a retrace back to retest this kind of 429-ish area on the spider. So what are you guys' take on this chart, the S&P, as well as the GDP number?
Well, what I see here, if we're looking, I mean, we can look at the SPY. I'll take those dunks off. I called the top in July pretty clearly, which I don't ever brag about, but I was very vocally selling things like Meta in July. And yes, it went a little bit higher later, but here we are and things are not looking that great. But all I see on these charts now at this point is lower highs and lower lows, right? And to me, that's a bearish market structure, and prove me wrong, right? So like I said at the very beginning, when I said I'm buying the dips on Bitcoin, I'm selling the rips on stocks until we see a higher high. This is bearish market structure. Every opportunity that goes up to me is an opportunity to sell something. That's how I'm going to approach it. I mean, look at QQQ. This is NASDAQ, obviously. Yesterday, this broke down below here. That made another lower low. And now you're gapping down massively. 50 MA way behind, approaching the 200 MA here. That 200 MA is long gone on SPX and SPY. Everything's resistance now. When you lose these things, if you're talking technically, when you lose all these levels, they become resistance on the way back up. And I just don't see it. But I do think, listen, now, by the way, I wouldn't be surprised if in the next 48 minutes, we see these wicks completely filled and see these close near the session lows. Would you?
I'll let Mike answer that one.
Well, that's probably actually more for the trader, but it's the hour of power. That's why I love the time you put this on, isn't it? And it's the true really flows actually come in the last hour. And that's what I'm showing is, to me, it's the Russell. Watching the iShares Russell, the IWM is it's just almost the same chart as Scott's, except you're showing, and you were showing, Gareth. It's just breaking down. And the key thing at this point is, like I mentioned, it's a psychology. Now, it's for traders to play for those bounces. But the way I look at it in the macro is don't be the weenie for the teeny and watch out for picking up pennies in front of the steamroller, honestly, because let's look what's happened this year. We had this pretty significant, I think, counter trend bounce. To me, it's 1930 all over again. The stock market dropped 50% in 1929, rallied 50%, and then everything tilted. I think we're tilting over to the big picture negative. Now it's global. If you look at the Nikkei, it was down 2% last night, and it's happening everywhere. So that's, to me, now is part of that. What I'm fearful is we're starting to kick into the reality of lower prices will beget lower prices, because we've have for at least a decade learned that lesson of every dip the Fed was there to save you. That's changed. The facts have changed. For most of my lifetime, every single time the stock market was down 20%, the Fed would ease. They're not doing that this time, and we're clearly heading towards that recession. Now, if you look at the GDP number, rearview mirror, no. But if you dig into that number, it doesn't get any better. It's ticking down hard. So I look at his equities are pretty significantly overvalued. I look at it in the macro as we talked about TLT. I think the next big trade is going to be normal. Stock market's got to drag everything lower and question how far. And as far as trading, I divert to you, Gareth and Scott, on that. I just look at it as we mentioned, Scott and I mentioned beforehand, is since I've been to Bloomberg, I haven't been allowed to trade. It's been the best thing that ever happened to me. It's like I used to be addicted to coffee, and that's why.
Rogaine, the hair's going to start coming back, Mike.
No, man, I don't want that. I'm already good. I already kind of learned that lesson in low maintenance. But that's the key thing I really watch you. But the key thing as an ex-trader, you look at, okay, what would I have done wrong? What might I have gotten right? And that's where I look over, as in this case, playing for the dips, you do that well, but I'm not good at it.
Yeah. So just jumping in, you mentioned like the 1930s, and I just wanted to show this. I'm not going to go back to the 1930s, but you're right on that. But just take a look at the NASDAQ monthly chart from the .com era, and you see this low. I kind of put this arrow here, and look at the run up, look at the retrace, look at the massive bounce, which convinced people that there was a new bull market, that we were going back to all-time highs, and then look at what happened afterwards. And then if we zoom forward and we zoom all the way up, look at that same market structure. There's your big run up, your pivot high, your pullback, your up move. And then again, if we extrapolate this out, it actually, I mean, if this repeats the .com era, we're headed a lot lower. And again, I know your target was that 3,000 level on the S&P. This potentially, if it repeated what we saw in the .com era, could be a lot lower than that too.
Yeah, that's. I'm trying to pull up my chart. I haven't found it yet. Of just taking the S&P 500, overlaying it with that's the Russell. I'll do the similar one, which is with gold. Overlaying, we take the S&P 500, you overlay it with GDP, U.S. GDP times 100, and right now you get basically 2,700 in NASDAQ. Go back to 1929, 28, 23, I think, in that chart. It's basically the same thing over time. And right now, just S&P 500 is just really expensive. So here in this case, it's very expensive versus gold. Now, we've seen that before, and it always comes back. Is it different this time? And I think that's to me, it's part of what I think most economists, strategists, and market practitioners have underestimated, me included, is the significance of what has happened in the last 3 years. The biggest pump in liquidity ever, COVID shutdown, all this money pumped in the system, and now it's trickling, going away very fast. And the key thing that we've pointed out this year is this fiscal stimulus, almost 8% of debt to GDP, increasing that much, the economy hanging in there in that environment. That's never happened without a recession or war. And it just shows what's been pumping up the stock market and the economy, and where's it going to go? That's where I see gold as well. This is a bull flag, you might call it, Garrett, going back last year. It's just waiting to go up. Yeah. And S&P 500 just looks just like it's waiting. It's just a little reversion back to 3,000. A big picture, it's nothing.
So Mike, or I should say Scott, do you think that, I saw a question like, will TLT maybe trade back to 100? I know you and I are both long TLT.
I'm mega long TLT right now.
So I mean, I'm in the camp that we're probably close to rates being toppy or at a top, if not at a top. And my thesis there is simply that if rates go much further, something is going to break, which inevitably will then cause the Fed to come out and make sure that rates come back in a little bit. Now, it doesn't necessarily mean we're going right back to 2% or 1%, right? I think we all agree that higher for longer is here. But again, I'm in the camp that at least we do see a pullback. And Scott, I assume you're kind of in that camp too?
Yeah, 100% in that camp. And you and I both bought more TLT. Yeah. We're talking about it, I think, on Monday morning or Tuesday morning. And then Bill Ackman tweeted that he had covered his shorts on bonds like right afterwards. And I wasn't sure if that meant I was in the mind of a genius or if I was getting played and I was one of the sheep on the other side of the trade. But I was happy to beat TLT. I mean, you guys talked about the Russell, obviously, before. That's at the bear market lows right now. listen, a lot of things look buyable at support right now, to be quite honest. Like a lot of these things are hitting support. It's an easy trade to cut if it loses it, but not really touching it. Can I do something optimistic that's not about today? When you guys were talking about the Great Depression, I pulled up one of my favorite charts that I made a long time ago, just to give you guys an optimism. Now, given this is not adjusted for inflation, so it's always based on the dollar, but this is the Dow Jones for history. And I've pointed out every major panic and market crash in history, including the Great Depression here. I just want to remind you guys that as much as we talk about what to do this hour, this day, this week, this month, it always goes up and to the right with time, right? Yeah. The Great Depression even looks like a blip. The Great Recession, when you go out to 12-month candles, it's one bad candle, right? Yeah. COVID, epic candle, right? Big wick, closed higher than it even opened that year. So I just want to remind you guys, I know it can get easy to get caught in the weeds, to get scared here, but the dollar's always going to inflate. These assets are always going to go up with time. So you may be looking to short these things like we're talking about in the short term, but eventually it's going to be time to get mega long for a mega long time.
Totally agree over a long period of time, but I'm going to play devil's advocate on this side, right? So yeah, like if your time horizon is 20, 30, 50, 100 years, I have no doubt that it'll go up. But I want to show you guys this chart. This is the Hang Seng. Now, if you were like a Bitcoin buyer at 69,000 and we equate that with this high in 2007 on the Hang Seng, which is the Hong Kong market, you literally have not made money since then. And you basically broke even at one point over here. And the other thing I'll just show you here, and this is actually one of my favorite trades going forward. I'm a huge fan of the EWZ, but the EWZ is Brazil. And Brazil, and by the way, look at this beautiful little bullish consolidation inside of this bigger pattern here. But Brazil, if you look at this, in 2008, it hit a high on the EWZ of $54 and change. It has never gone back there yet. Now, do I think that eventually it will and break out hugely higher? Yes. So if your time frame is long enough, yes. But part of my thesis, honestly, with the S&P and the NASDAQ is that we might be stuck in like a 10-year period where we don't take out those highs.
But let me also refute one more data point there. If you look, there's a great website. I don't have it pulled up, but if you dollar cost average Bitcoin starting on the day it was 69,000 and bought every week, you're way up.
That's true.
You're way up. And you were still up when it was 25, because the fact is, even if you bought the dead top, if you kept buying like you're supposed to as a diligent investor with the long-term thinking, you spent a lot more time buying when it was low than you ever did when it was high, because the rip was so fast. So even it is important to note that even if you bought the top, if you only bought the top and your whole plan was go all in at the top of the FOMO, yeah, you're pretty screwed, right? But if your plan was to passively invest in an IRA in one of these assets and you're buying every month, you're probably up on almost everything.
Yeah. And I think that's the key, folks, is if there's one thing you take away, and I know Mike would agree with this as well, is that you as soon as you let emotion creeping into your investing decisions, that's where you'll make the wrong decision, right? So it's very important to have a very logical pre-laid plan, because you're right. Then if you bought at 69,000 and you said, all right, every month I'm going to dollar cost average, you're probably at around 40,000 by now, and potentially a little push, and all of a sudden
you're lower. I think if it was weekly buys or something, you're at like 21 or 22. Maybe pushing towards 24, 25, but it's pretty low. Yeah.
So I think that is the key, folks, is that, if you get panicky, so you buy the top because it's emotion, right? And then if you sold the 15,000 bottom because you panicked, then again, that's the emotion coming into play. And one of the biggest things for investors to remember is you just got to have that plan. And if you have your thesis, you stick by your thesis, and dollar cost averaging methodically is really an amazing thing.
So I love those kind of narratives. We've heard them since the day one in businesses and in studying finance and everything. But one thing I do not like to point out on the devil's advocate side, the situation we're in right now has no precedent in history in terms of the pump and liquidity that's still dumping. And the lessons from the movie, the book, Boom and Busts, is all busts come on the back of big pumps. Now let's look at 1929. That peak, I think, lasted until the early 50s. Let's look at 2007. That peak lasted for 13 years, I think. And then, of course, the peak in 2000 lasted for quite a while. And I think that's where we're heading for. Now, to me, always, I've seen some of the best. Yes, in the long term, you're supposed to have equities, but there's times where you're overweight and underweight. And I think this is clearly a time to be overweight things like 2-year notes and TLT and treasuries across the curve. And almost every single time, and I'm only 59, I've heard it a few times in this business. Every time I hear that, oh, that long-term, I have always heard it, that long-term thing that we're just talking about, that trend is over. I remember hearing a lot in 2002, and certainly some of it in 2009. When you start hearing that it's over, that's when it's time to buy. And I think one thing to remember is we've created so much wealth with the boomers at the peak of the curve now. And if you're a boomer and you're not buying 2-year notes, it's kind of silly. Because you don't have the time left in diversification in the stock market. To me, this is why I'm willing to make that risk, that this is one of the greatest resets of our lifetimes. And the good news is 2 years from now, if you only make 10% in that 2-year note, you can say, hey, McGlone, you're an idiot. And I could have made 20% like Scott and Gareth in the stock market.
No, I think
they can buy it in bonds. Treasuries with you, yeah.
Speaking of investments, let's touch on gold here, right? So are you guys as impressed with gold's performance recently, right? So we've seen the dollar go up the last few days. We saw this massive move, which I actually thought, so I'm in the camp that we were going to consolidate. I just thought we'd even pull back a little bit more than this. But so far, gold is holding up like a champ. Are we headed by year end to maybe this 2080 level, this kind of retesting of this triple top?
Well, I'll give you my take on gold. To me, it's just a matter of time. It breaks through. I don't have that chart up right now. It breaks through to right there. This is what I'm sorry. This is the. It was Bitcoin. It breaks through 2,000 and goes to 3,000. It's almost exactly what it did in 2008. And I'll have a chart coming up right now. It's just going to be a second to bring it up. Bringing it up, and. But just like you pointed out before, it's got to frustrate the most people, and it has done a pretty extreme example of that. But the thing, it's going to take a second. It's my system's running slow today, and
you're a Bloomberg man. You should be like the speed.
I know.
You should be like.
I know.
You should have the Neuralink for your charts. It's crazy.
So this is the key thing I want to point out about gold. And you see gold in gold. I mean, it just keeps bumping up. This is a monthly chart. Total ETF holdings have been plunging. I mean, this has never happened since ETFs have been traded on gold in almost 20 years. They're down about 8%. 10% this year, and gold's up almost 10%. That's never happened. So I think that's indicative of what's going to happen is higher prices in gold, I think, will bring out higher prices. It's just, I think it's going to see FOMO, and this will turn higher once people are convinced, like the stock market's going down, they're starting to allocate towards Bitcoin. Once people give up on this and realize that, okay, well, we're going to get a normal correction in the stock market for recession. Once they do that, which I know will happen, it's just a question of when, this will tilt higher. And remember, gold is so global. The deepest pockets in the planet are buying it. So I see one thing, I'll end with this, is what's really happening in gold is real yields. That's what you see here. The last time we had, this is the Fed funds minus CPI. Last time it was this high, meaning in terms of it's almost 1%. That's when gold bottomed around 2015. Remember, that's right when the Fed started hiking. And this time it's different. It's going to be at some point, where do we get that pivot? The pivot from the Fed. And to me, it's just a matter of time. But again, I've been saying that for about a year, almost. Here's what, to quote Roger Babson, who nailed the stock market in 1929. In a speech in 1929, he said, "I will repeat to you the same thing I said this time last year and the year before." And that's what I've been saying in gold. I have to admit that.
So Scott, is a pivot from the Fed, is that like them just pausing, or do they actually have to cut to be a pivot?
Oh my God, I will die on the pause is not a pivot hill. Rand Neuner and I had that argument the day that they first paused, and he was screaming that it was a pivot and they were going to start cutting. They've raised since then. So the answer is clear. And I'm not trying to disparage him at all. I'm just saying I got very emotional about it. A pause is just saying, hey, we're going to actually be smart and wait and see what these cuts and hikes, either way, we've done in the past are doing to the market, get more data so that we can make a more informed decision. I think they might even still honestly raise 0.25 again, if not even more. That doesn't mean that I think they should, but that is what I think that they will likely do. This is still just my TLT chart sitting here. But no, a pause is not a pivot. And it should be noted, now I'm going to have to click through and find the chart. It's probably over here. We've talked about this quite a few times. The yield curve is uninverting rapidly here. It's at 0.19 now. We know that generally the yield curve normalizes, then you get the pivot, then you get the stock market crash, right? A lot of people are pointing out that this time is different because usually when the yield curve uninverts or normalizes, it's because the Fed is manipulating the short end, right? they've started cutting
Good point.
the 2 years such.
Yeah.
And people don't realize monetary policy determines the short end of the curve, but fiscal policy, which is the Treasury, obviously more determines the long side of the curve. And right now, the rates are both rising. It's just that one is rising less than the other one. This is a different situation. And frankly, it's much worse.
So it's a great reset scenario. It's a great reset scenario. And I will tilt back to my screen a little bit. Just what you said, Scott. This is the key screen I've been pointing out all years. Fed fund futures right here are still pointing towards higher rates. They're at 5.40 for January. They're still hiking those rates. It means the stock market has not dropped enough yet to take the tightening out of the system. A pivot comes when they start easing, or at least start pricing for easing. Now, the market's priced for that in the future, but this has been wrong all year. You go back to like January, it was the same thing a few months ahead. It's been wrong all year. That, to me, is part of that lose-lose, what you point out, Scott. Yields are spiking. That's bad for everything. I mean, it just contracts small business activity. And the Fed's still priced for hiking. This is just a lose-lose for risk assets. And at some point, we need them to drop enough for the Fed to ease, and we haven't even started. We're nowhere near that pivot. We have to at least get in the price for ease, and then the market to see if they're gonna ease.
Hey, Mike, if we get like a Black Monday sort of scenario, do you think they pivot quick?
Yeah, so that's what I'm worried about. This is the 94th anniversary of the stock market crash in 1929. It all started really at the end of October. Obviously, I've been doing my rereading and too much of it because I was fixated in that period when I was a kid. And so that's the key thing that will change things. It's the number one reason for the Fed to ever pivot is the stock market going down. It's the best leading indicator on the planet, bar none. I'm happy to argue that with people. I can show you the data. So that's what I think. But the thing is, it needs to, typically it only takes one day. One day to flip their switch. Oh shit, we're down 5, 6, 7%. Yeah, that's enough for them. But we're not even this death by 1,000 knives is not enough. You see this little thing here says we're down. I think we're up. The Nasdaq was up about 40% on the year. Now it's 29% on the year. That's not enough. That's what the market's telling you. It's not enough.
So just as we come to the end of this, I have a couple things. Number one, Amazon reports after the bell today, so that'll be an interesting chart to watch. We have seen it kind of collapse on the back of Google, obviously, and then Meta even kind of caused some downside today. Next support I have, and by the way, I don't know which way it'll go on earnings, but I do have the next support around 114, this pivot high going back to February of this year. And then the other thing just to point out here is that if you look at NVIDIA, and I saw a question on this, NVIDIA today looks like it's triggering this head and shoulders, right? Shoulder, head, shoulder. It looks like it'll close below. So just something to keep an eye on here. NVIDIA, again, struggling. If the market can bounce, maybe it can recapture this trend line here, but that's not a great chart overall. It's a classic head and shoulder top. And again, if you're in my camp, I look at it and I say, yeah, their margins have been amazing. Their earnings have been amazing, but every other semiconductor is coming at them fast because the margins are just too good for anyone to pass up. Same thing happened to Tesla, right? And then all the other automakers came to put out EV vehicles. So that was that. Just I wanted to mention that. And the last thing I'll ask you guys before we sign off is, in 2 years from now, do we look and say, wow, the Fed really screwed this up big time? Yes. Or are we going to
in 2 years, at any point, if you look back 2 years and ask me that question, I will tell you that the Fed screwed up 2 years ago because they've never been right about anything ever.
Fair enough.
So I hate to agree with that, but I have to agree with it. And I think the bottom line is, let's not forget where we were 3 years ago. Widespread fear of death. On a global basis, none of us have ever lived through that. None of our parents have even lived through that, except for maybe some wars. And those are more isolated. But widespread fear of death was the best reason, I think, ever to create this biggest liquidity pump in the history of mankind. And it's still dumping. It's just the simple rules of cycles are all kicking in, and you can't figure it out in a day trade. I haven't been able to.
And I think a good point to that is that we've now seen the worst bear market in bonds in history, right? I believe it is. So it's you can see it already unwinding in certain ways like this. That really tells us. All right, guys, let's wrap it up here. It has been an awesome Market Mavericks. Thank you, gentlemen, for joining and giving your opinions and your views and your analysis. And I can't wait to see you guys next week. But lastly, I'll just say, go follow Scott, his YouTube, anything else, Scott, you want them to follow you on Twitter?
Oh, good. That's good. Thanks. Good.
All right. Yeah. And then Mike, same thing, buddy. Follow you on. Are you on YouTube, Mike?
Twitter and LinkedIn.
Twitter and LinkedIn. Go follow him as well. You guys, thank you so much for coming out, and I will see you all next week. Take care.